Well, we ended the holiday shortened week with quite the news flow. Of course, we had the Mueller report first thing in the morning, and then shortly after that, we had the so-called tech unicorn IPOs of Pinterest and Zoom come out. Both of those did price at levels that exceeded original expectations. The markets were largely lower throughout most of the session, but did have a pretty nice pop near the end of the day. In fact, the Dow Jones Industrial Average ended up hitting a multi-month high here today. All of our postures do remain bullish at this time. What I wanted to focus on in our trade application example today was something that's not in the stock market, it's in the bond market, but could be setting up for an interesting kind of neutral trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 18th, 2019. First of all, if you're new, welcome aboard. Thank you for checking out this video. If you like what you see, make sure you go over to our YouTube channel and click subscribe. Once you're done with that, go to our description area and sign up for our email distribution list as well. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee, and thank you to everybody who clicks like and retweet to get information out about these videos on a daily basis. Lastly, we also have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. This is going to be the 4 grid that we present to you, which shows us the 4 major U.S. equity indices plotted over 3 months worth of time, and then using that market forecast technical indicator at the bottom of each one of those charts. As you can see, the S&P 500 was up 0.16% today, so not a huge day, but nonetheless, it did close well off the lows of the session. The Dow Jones was actually much more robust here today. Notice that the Dow Jones not only hit an intraday multi-month high, but actually had a closing multi-month high here today as well. The Dow Jones is actually up 0.42% today. The NASDAQ was just barely above break even. It did eke out a gain of 0.02%, but again, similar to the S&P 500, we closed largely off the lows there. In fact, the NASDAQ appears to have closed at its highs, even though it was not very much above yesterday's closing price. The laggard continues to be the Russell 2000, and that's something that we've kind of shared with you here for the last several weeks. So this is not new information, but it continues to be the case. The Russell 2000 was actually down today. It was down 0.12%, and as you can see, they have not hit a multi-month high in quite some time. They have not overcome that high from back in late February at this point, whereas the other indices have. And as you can see, this is the one that is the most concerning from a posture perspective as well. Notice the background colors of all 4 of our charts have that green background color, telling us that the intermediate line is bullish, where it currently resides for all 4 of the charts. But it's this one down below here in the Russell 2000 that remains a little bit more problematic, just because you can see that that green line is kind of reversing course. It's in the upper reversal zone, so that's why we still consider it bullish. But if it were to cross down and below 80, we would then start considering that to have a weekly bearish posture at that point. Right now, that green intermediate line is at 83.86. So if there are, more sell-off days early next week, of course, we're not trading tomorrow because of Good Friday, but early next week, if there's more of a sell-off in store for the Russell 2000, you might very well see that they move to a bearish posture before the other indices that seem to be holding up quite a bit better. Let's go ahead and take a look at our next chart now. This will be our 3 green arrows chart. Setup 4C is the chart code for those of you that are premium market scholars that want to follow along at home with your charting package. So as you can see here, there are some changes from when I did the presentation on Tuesday, just 2 days ago, and that won't always be the case, but it is right now. And what we are seeing is a little bit of deterioration in the strength of the market. I can identify that through this chart because I can see that we no longer have 3 green arrows in most of these charts cases. Notice that we have a red arrow that came into the MACD histogram on the S&P 500. on the NASDAQ Composite and also on the Russell 2000. So as it stands right now, the only chart that remains in 3 green arrow territory is the Dow Jones Industrial Average. It maintains its green arrow on the MACD histogram. Of course, it's above its 30-day moving average up here, and we do have stochastics in the upper reversal zone. So I guess if you're looking for trend trading setups, it appears that the Dow Jones and kind of that mega cap, perhaps more of an international type of a feel to the companies, could be a place to be seeking them out. In fact, I just mentioned here a moment ago on Twitter, I happened to see that a lot of big, well-known international type of companies are hitting new highs, including Procter & Gamble, Kimberly-Clark, Hershey's, and a few of the others there. So those are the types of companies that would be kind of in that same type of conversation. I know Hershey's isn't part of the Dow Jones, so I don't want to make that seem like that's the case. But Procter & Gamble is certainly part of the Dow Jones and continues to bolster that particular index. So it does seem like this is a decent place to be looking at those mega cap international types of companies. Let's now take a look at our next chart setup, which is the chart 4D in this case. This is our 1040 crossover method. Now remember, this particular chart setup, which is chart 4D, is going to go back over a longer period of time, 3 years in length as opposed to 3 months, and every one of the candles you see on the charts is a weekly candle as opposed to a daily candle. And as I reported to you guys earlier this week, and I'm sure David's probably been talking to you about this as well, we do have that positive or bullish crossover that has occurred on the Russell 2000. And while it does lag the other indices, we were able to stay with that bullish posture for a full week, since today is the last trading day of this week due to the holiday. And so we will remain with that bullish crossover. Now remember, we are kind of in that that period where we could easily have a fake out type of a situation. If the Russell 2000 were to start falling, we could easily see us go back to a negative crossover reasonably quick, whereas I would not expect that to be the case with the Dow, with the S&P 500, and with the NASDAQ Composite. All of those charts look very, very strong. In fact, most of them are very close to all-time highs, within just a 1% or 2 in most of those cases. And so right now, my expectation is that we will hit all-time highs. Whether that happens or not is anybody's guess, but the momentum seems to be on the side of the bulls. April is traditionally a more bullish time of year. Of course, everybody gets a little bit more concerned in May with the whole sell in May and go away battle cry, but we're not to May yet. We are still in April. Trends are still strong. IPOs are coming out hot. And I have a feeling that market makers are incentivized to keep markets at higher levels right now because they want to see Uber and some of these other IPOs come out while the getting's good, so to speak. So I am preparing myself mentally for a breakout to new all-time highs here reasonably quick. Now, there are, of course, challenges out there. Part of it is what's been going on with healthcare here recently. We'll talk about that in a little bit. And of course, other news stories and geopolitics, et cetera, et cetera. So there are obviously, reasons why the stock market might struggle. It is not a given that we're going to have all-time highs, but if you're trying to set your next best trade and set your assumptions, then I think it does make sense to assume that all-time highs will be achieved sooner rather than later. All right, let's go ahead and take a look at our next chart setup. This will be chart 4E. This is our intermarket analysis 12 grid. And as this pulls up, remember that the background colors will tell you whether we have a bullish or bearish posture according to the market forecast intermediate term line. And if the charts are pink, that means that the trends or the posture, I should say, is bearish. If the charts are green, then it means that the posture is bullish, again, according to the market forecast indicator. And there are plenty of different technical indicators out there that you can use to set your posture. Market forecast is only one of them. But for those of you that like that sort of thing, that's kind of the emphasis that David and I tend to have during these videos. And so as we look at this, one thing that did catch my eye today was the dollar. Notice down in the lower left-hand corner here, this is the chart of UUP, which is kind of a good proxy for the dollar. The dollar did break out to multi-month highs here. Notice that not only did we hit an intraday high, but we closed with new closing highs as well. And that was important because we had a very prominent candle back here on March 7th. Notice that we closed at the high of that particular session, but we immediately gave up the ghost. And that thing basically went into a kind of a downward spiral there for the next couple of weeks. So it was a bit of a head fake at that particular time, and that kind of stood out there for quite some time up until today as that resistance area that bulls were going to have to get through if they wanted the trend to continue. Notice during that time we did have a bearish cluster or an overbought cluster on that particular day, so perhaps there was a technical reason to send that dollar lower after that. But today we don't have that. I don't know how close we are. We could probably right click and go to maximize sell and see how close we are. If the red line would have been up in the upper reversal today, we would have had a overbought cluster just like we did back here, but we weren't quite there. And so perhaps we have a little bit of upside potential. But as you look at this chart, I would identify this as an uptrending security at this point. It got a little hairy during this time period because I would call this more of a double bottom or an equal low as opposed to a higher low. But nonetheless, it kind of self-corrected itself, and it has spent the vast majority of the last 3 months above that rising moving average. So right now, it appears the path of least resistance for the US dollar continues to be to the upside. Now remember, sometimes that can have a negative aspect on commodities, but it didn't really seem to influence them all that much today. Perhaps it's because commodities had already been in a little bit more of a difficult patch. Notice in particular, gold down here has really struggled for the last, let's call it week and a half or so. And it got to a point where we actually got an oversold cluster signal yesterday. So perhaps that's the reason why gold was up a hair today as a little bit of a reversion to the mean type of a move, despite the fact that the dollar was so strong here today. So keep your eye on that though, because the expectation would be that if the dollar continues to move higher, commodities would be pressured, all else being equal. Now, as we've been pointing out recently, crude oil seems to be bucking the trend of other commodities like your soft commodities and your metals. Crude oil continues to just kind of dance to the beat of its own drummer, so to speak. It just continues to be a workhorse to the upside. Perhaps it was a bit too oversold at the end of 2018, so it's kind of working back to where it's trying to seek price and where it deserves to be given the supply and demand of the macro situation around it. So right now, crude oil prices continue to be resilient to the upside. And you'll notice that has allowed junk bonds to kind of buck the trend of other interest rate sensitive securities. Notice that junk bonds continue to have a bullish posture. We're up again today and continue to rise with a nice trend, whereas a lot of their counterparts, and you look at government bonds from the US, foreign bonds, real estate investment trusts, master limited partnerships, and preferred stocks, all of those have pink background colors with more of a bearish indication towards them. So I really think it's crude oil that is helping junk bonds buck the trend of a lot of the other kind of proxies for interest rate environment out there. But as it stands today, TLT was up 0.52% today. And of course, the inverse of that is that TNX was down today. So a little bit of a reversion to the mean type of a move there for each of those as they both kind of bounce back towards the moving average. We'll see where that leads us starting early next week. Let's go ahead and take a look at our next chart setup, which will be chart 4F, and these will be the foreign stock markets out there. And as you can see, things continue to hold up reasonably well. A lot of green charts on the board, a lot of bullish intermediate term postures according to the market forecast. One that I thought was particularly interesting was Israel. You can see down below here, EIS continues to be in what I would deem to be an uptrend. Might not be the most robust uptrend you've ever seen, but nonetheless, you can see that it's been carving out higher highs and higher lows for the last 2.5 months or so. We have pulled back fairly strongly in the last 2 days. You'll notice that Israel was down over 1% here today, but notice where we kind of ended the week. We ended the week with a bit of a hammer-looking candlestick pattern on top of a support area known as a rising 30-day moving average. So this is kind of an interesting choice for those of you that are looking for bounce trades out there. Note that the pullback in the last 2 days has not changed the posture from bullish to bearish. We still have a green background color here. So we have a bullish intermediate term posture according to the market forecast. We have uptrending series of higher highs and higher lows from price action alone. We have price resting atop a rising 30-day moving average. And so if you do believe there's something to be said here for foreign investment attracting more dollars, then perhaps Israel will be an interesting one to keep on your radar. Keep it on your watch list there. Now, keep in mind what I mentioned before regarding the US dollar. If the US dollar continues to be strong, then the assumption would be foreign markets on a relative basis will struggle compared to U.S. assets. So that could be coming into play as well. But I do think that Israel is at a very interesting juncture right here where if there is going to be a bounce, you could theoretically see this get back up and over that high that it set just a couple of days ago in relatively short order. Other things to be aware of with these particular charts here. Brazil remains the only one on the board with a bearish posture at this current juncture. However, Brazil was actually up 1% here today, trying to buck that trend a little bit, but just not enough to actually kick that back into a bullish posture at this point. Mexico had a little bit of a breakout attempt here earlier this week. However, be aware that we do have an overbought cluster signal as of yesterday's trading in Mexico, and so it'll be interesting to see if this needs a little bit of a cooling off period before continuing to the upside. Let's go ahead and take a look at our next chart setup, which will be the U.S. Sectors, and that's chart 4G. As we look at this, of course, the big story of this week has been healthcare. Notice that healthcare has absolutely fallen out of bed here for the last, let's call it, 5-6 trading sessions. Today we actually closed higher, so at least that's a start for those of you that are hoping that a bottom is in sooner rather than later on healthcare. It was up 0.16% today. However, it's obviously been breaking lots of support along the way, and you can see that the price action was so significant in the last few days that it's actually pulled the moving average down now. And so that moving average, as you'll note, actually turned red, which tells us that price is below a falling moving average. And so even if we do get a bounce higher, it's possible that that is a bounce that is worth selling and not a bounce that's worth buying into. So that's kind of the difference between that and Israel. Israel's still in an uptrend. It has pulled back the last couple of days as well, but it remains with positive momentum to the upside. Healthcare has turned to the point where we have negative momentum to the downside. And therefore, if we do happen to get some sort of a bounce from here, and that's entirely possible, note what happened here today with XLV. We got an oversold cluster signal. So let me right-click on the chart and then go to maximize sell so you guys can see that in a little bit better detail. We had all three of our colored lines on the market forecast close in the lower reversal zone on the same day. So that's what produces those oversold cluster signals. Now remember, when you get an oversold cluster signal, the assumption is not that this thing is just going to bounce from here and skyrocket to new highs. It could, anything's possible, but the expectation, at least in my head, is that when we get those oversold cluster signals, the coming week or a couple of weeks will not look like the last couple of weeks that put us into this condition. So that could mean a number of things. I don't expect that XLV is going to have these type of candles for the next week or so to the downside and continue this move, but it doesn't necessarily mean that we have to go straight back to the upside either. We could easily just go sideways for a while on XLV, and if we do happen to get lucky enough to catch a bounce to the upside, I would be fearful as to where XLV would take us. If it would take us just up to the underside of that downtrending moving average, that's an area where I would probably look to put on some more bearish trades towards those healthcare stocks. So, be on the lookout for that possibility early next week. But without a doubt, that was the story of the week. As I mentioned on Tuesday, we already had a heads up about that on the sector selector that was produced last Friday because healthcare fell all the way to the second to bottom ranking. And I would not anticipate any sort of improvement upon that when I produce the sector selector this weekend. Now, normally I do that on Fridays after the market closes. Since there is no trading tomorrow due to the Good Friday holiday, I will plan on getting that sector selector out to those of you that like that a little bit earlier in the day on Friday as opposed to later. But yeah, I don't anticipate that healthcare did itself any favors this week. And if anything, perhaps we'll even see healthcare move from the 10th slot down to the 11th slot when the official rankings come out. Notice that we also have utilities and real estate with bearish postures as well. Utilities had kind of been in that bearish posture mode for a little bit of time, and it was a bit peculiar seeing real estate continue to go up at the same time utilities were selling off a little bit. But this week, that was another one of the big changes that we saw from a sector perspective. Real estate did start kind of moving towards the downside to kind of play a little bit of catch up there with utilities that had already given us the heads up that that was possibly going to occur. Notice that both of those are now trading below their 30-day moving averages at this current time. So healthcare, utilities, real estate, all trading below their moving averages. All the rest of the charts are trading above their moving averages. Somewhat surprising to see staples do so well. I mentioned Procter & Gamble and Hershey's and Kimberly-Clark and Costco and some of those here a bit ago. So all of those are helping, maintain that strength for the staples. But you traditionally wouldn't expect that to be the case if you see a lot of those other defensive areas kind of breaking down the way that we've seen. But the good news is most of the other kind of risk-on types of sectors out there are holding up quite nicely. It just seems like technology refuses to go down. Of course, we had the big news earlier this week about Qualcomm, and that sort of helped out the whole complex, the semiconductor complex, and Apple was a part of that as well, helping out some of the hardware stocks. But nonetheless, we do find technology continues to be an area that attracts investment dollars and hit yet another multi-month high here today. I'm also impressed with the way that the industrials chart has been shaking out. Notice that the industrials were up 1.15% today. We closed near the high of the session, so we closed at a new closing multi-month high and an intraday high, of course, as well. So cleared out some of that resistance. And remember, industrials weren't always playing nice the entire go-around here in 2019. There were other more stellar charts out there, but it does look like industrials are kind of coming into their own now. And remember, that was another one of the big changes we saw on the sector selector last Friday, is that industrials ramped up to the number 3 slot. So again, same kind of concept as I mentioned a moment ago with healthcare. Tomorrow when I put the sector selector together, I'm assuming that industrials probably maintained their third ranking, perhaps might have even moved into second place. So we'll have to take a peek at that time. But industrials have impressed me here recently, and there may be some interesting bullish candidates from that perspective as well. Real quickly, I want to thank all of you that clicked like the last time I did the presentation on Tuesday. Over 100 of you did so, and that's kind of my number I have in the back of my head where I have a smile on my face, and I'm not going to, twist your arm too bad and beg you the way I normally have to during these videos to click like. Thank you for doing that. If we could just consistently maintain 100 likes or more, then, life will be grand, and we'll continue to do these videos and, everything like that, and everybody's happy, right? So keep up your end of the bargain. I'll keep up my end of the bargain as well. Thank you for doing that. Remember, no classes tomorrow or Saturday due to the holidays, but we'll get back into class on Monday with my top-down trend trading class, and then later on that afternoon I'll teach my options for long-term investors class as well. For those of you that are looking for something to fill your time over the weekend, since you don't have our normal premium classes, I did teach my question and answer session here today, and that is now posted. And so for those of you that want some insight on Qualcomm and Walgreens and Merck and Sunoco, and just having general positions in SPY, QQQ, John Wiley, United Healthcare, McDonald's, There's Qualcomm and Walgreens yet again, talking about some of the healthcare industry in general, and then specifically with AbbVie. If you want any of that type of insight directly from me, of course, if you're a premium member of Market Scholars, it's waiting there for you. That's 2.5 hours worth of analysis right there. So a great way to fill up your Friday if you're thirsty for additional market information. All right, let's go ahead and get back on over here now to the charts, and let's talk about our trade application example that I wanted to share with you here today. I'm going to go over here to chart 4A and just look at kind of the market forecast view over the last 3 months here. And what I wanted to focus on today was TLT. And TLT is, the ETF that tracks the long government bond here in the United States. It is one of the few ETFs from a bond perspective that's liquid enough to do what's known as an iron condor. An iron condor is a options trade that requires a multi-legged mindset. In other words, there are going to be 4 different strike prices involved, and so you need to have excellent liquidity with your underlying product if you want to implement that type of a strategy. If you try to do iron condors on illiquid securities, you'll oftentimes find that your pricing will be inefficient and it will multiply upon itself because of all the strikes that are involved, and usually you're going to have a harder time making a profit as a result. So a lot of times if we want to kind of make a decision on bonds in general from an options perspective, oftentimes we do use TLT. And you can kind of see what the chart of TLT looks like here. Over the last 3 months, it is up. You can see that TLT is up about 2.25%. So there's a slight upward bias to TLT. However, note that most of that upward bias was created during this time period here in mid-March as we ramp towards the end of the month. But since then, we've really been selling off. And where we kind of reside at this current moment in time is actually almost dead flat in the middle of where our trading range has been over the last 3 months. And so if you assume that that will continue going forward, in other words, largely sideways trading action, then perhaps a neutral-based strategy like selling an iron condor could be useful for you. Note that there was a lot of volume that came into this product today as well. Technically, there is a bearish posture according to the market forecast intermediate line, but nonetheless, we did actually get a little bit of a positive bounce to the upside. So again, a lot of mixed signals, whether you're bullish or bearish, or bullish or bearish. And sometimes when the bulls and the bears have equal arguments against one another, perhaps the right decision is to do something where directionality is not required for your success of the trade. And that's, of course, what the iron condor will allow you to do if you are accurate in that analysis. So what I will do for this trade is come on over here to the trade tab, type in TLT in the ticker symbol box. And I've gone out to June in this case. A lot of times I would probably stick with the maize, but in this case, because we are dealing with a product that has really low implied volatility, notice that it's 9%. Did I catch a niner in there? That is a extremely low implied volatility. Remember, typically you're going to find implied volatility on stocks maybe 15 to 20%, sometimes higher if we have a little bit more fear in the marketplace. So this is the bond market, so you have to kind of know what you're getting yourself into. And as a result, I found myself having to go out to the June contracts as opposed to the maize. But obviously, you're welcome to do the maize or whatever fits your parameters better. But in this particular case, what I found was that if I were able to load up the June contracts with 64 days till expiration, I was able to get a 30% return on risk at an acceptable level of looking for appropriate break-even prices according to the technical analysis on the chart. So typically, we start our approach with looking for deltas close to 20 to sell when we're doing these iron condors. And so you'll notice what I selected here on the put side of the equation. You can see the trade loaded up down below, -1, meaning I'm selling the 119 put. That's right here. Notice that our delta is exactly at 20 on that. So I'm selling the 119 put and I'm buying the 117 as kind of a built-in hedge in case I'm way wrong with my analysis and we think the stock, or in this case the ETF, is going sideways and it breaks out either huge to the upside or huge to the downside. Remember, that's why you have those bought strikes embedded within your iron condor to protect you from that type of a movement. So that's where I'm looking on the put side of the equation. On the call side of the equation, I selected the 126 call to sell, and so that's this strike right down here. And note that this is the 23 delta in this particular case. So there wasn't one exactly at a 20 delta like we saw on the other one. So I'm doing the 126 to sell, and then likewise to keep that at a kind of a balanced iron condor, we're doing a $2 wide on the call side as well. So that means that I'll be buying the 128 here, as you can see. So net, you can see that we're going to get a credit of 50 cents by transacting this, assuming markets open up close to where they closed on Monday morning, which, of course, with a long holiday weekend, that's anybody's guess whether that'll actually occur or not. But remember, if you do click confirm and send, you can review this one last time to see if you're going to get enough of a premium to make it worth your while. So you can take the max profit of $50 and divide it by $150, and you can see that that is a 33% return on risk. Now, I'm not here to say that should be your hurdle rate, but it is oftentimes what David and I will use when we're showing you these example ideas. We're looking for those return on risks of 30% or more. So this one would qualify under that type of a mindset. Also, while we've got this pulled up, note that the break-even prices are 118.50 and 126.50. So let me show you on the chart why that looks somewhat appetizing from a technical analysis perspective. If I were to maybe draw a couple of lines on here, let's go to a price level. And I'll show you on the top line here, and then we'll draw another one on the bottom. Let me right-click on the top line and change that to exactly where our break-even would be, which was going to be 126.50. And on the bottom one, do the same thing, right-click, edit, and 118.50. Notice that as I show you that, basically we make money as long as this stock stays between those two blue lines on the chart for the next 2 months. So if you are under the mindset that the next 2 months for U.S. government bonds is going to look awfully close to the last 3 months of what we've already seen, then perhaps a neutral strategy like an iron condor could be one way to take advantage of that. So let me come on over here, click confirm and send, and we'll send that off and see if we get filled first thing on Monday morning. All right, well, I want to thank you for joining me here today. Again, reminder, with tomorrow being Good Friday, there is no stock market trading, and therefore there's not going to be a market outlook video either. So this will be kind of our last goodbyes for the week, but we'll get back into the swing of things with a normal schedule starting on Monday as well. So I want to wish you all the best of success with your trades and your investments. Have a wonderful holiday weekend, and if you get a chance, go out there and click like on these videos if you get value out of them as well. Thanks again. Have a great day. Bye-bye.